Provident Healthcare Partners is a healthcare investment bank that is focused on transaction advisory services. We created this podcast for healthcare executives, entrepreneurs, shareholders, and providers who are interested in learning more about the world of healthcare consolidation.
Welcome to the latest episode of Provident Healthcare Partners podcast. This is Ajeya Shekar, a vice president here at Provident. We wanted to spend this episode talking about some of the most common questions we get around the financial aspects of an M&A transaction. I have two colleagues joining me for this podcast, Eric Major, who's a vice president with Provident.
Thanks, AJ.
And Dustin Thompson, who is a CPA and vice president also.
Thanks, AJ, and appreciate as we discuss some financials today and how companies are valued.
I think the most basic question we get out of potential clients and CEOs and shareholders of healthcare companies are, how are transactions valued? It generally revolves around a multiple of adjusted EBITDA, but Dustin, maybe you can help our listeners understand how we calculate adjusted EBITDA to start with.
Yes, one of the important things when we first encounter a prospect is just getting their income statement. From there, we obviously have their net income and can calculate their EBITDA, which is just looking at their depreciation, amortization, taxes, and interest, if applicable for taxes. Often our companies are shelling out all of the taxes, so that's not applicable. That's very cut and dry from there. Then we look at adjusted EBITDA. Because they are trying to get their tax number, ultimately net income to zero, we often have to add back the compensation. With that being said, they're just at a little higher compensation, but we'll get into that in more detail. Often, since we're working with closely held businesses as well, they're going to have non-recurring expenses as well as personal expenses. We'll both touch into those in more detail later on. After we add those three back, we'll come up with an adjusted EBITDA number that is based on what the multiple applied to get enterprise value.
And Eric, maybe you can help us out on the other side of the equation, which is the valuation attached to the adjusted EBITDA.
Yeah, I think on the valuation side, we spend time up front with potential clients in terms of putting together a valuation analysis from our perspective. And I think there's a few common methods that investment bankers will utilize, one of which is a discounted cash flow analysis, which is essentially discounting the future cash flows of the business to the present value. The second method is comparable companies, which would be evaluating some of the financial metrics from publicly traded businesses. And the third method is looking at precedent transactions, which is essentially looking at the valuations paid in comparable deals. I would say in the lower middle market to middle market of healthcare, the discounted cash flow analysis and the precedent transaction analysis are most often utilized. Comparable companies, if you look at a multi-billion dollar publicly traded company, it's typically not a great comparable business to look at, compared to some of our clients that maybe are doing $50 to $200 million worth of revenue. When it comes to actually going out to market, I would say the valuation is typically based on what the market dictates. So when you have competition from multiple different investors and strategic buyers, they're going to place an enterprise value on the business based on a multiple of the adjusted EBITDA. And what that multiple is really based on what the excitement of the buyer, certainly their perceived growth that they believe the business can achieve, any risks they see within the business, whether that's reimbursement risk or potentially if it's a provider-based business, there's a lot of revenue flowing through, a handful of providers, concentration among those providers. So those risks and growth opportunities within the business are certainly heavily weighed in the valuations that the private equity firms put together.
Those are great points. And I'd say for our listeners, the vast majority of the deals that we see within healthcare services are that adjusted EBITDA multiple. And while each company is different in terms of how they look at their financials on a yearly basis, like Dustin mentioned, some choose to minimize their net income for tax purposes. Others tend to have kind of fully baked GAAP or close to GAAP financials that don't necessarily need a ton of adjusting. There's a lot of work that an investment bank has to do in order to help a company position themselves for a sale, whether that's on either the EBITDA side of things or helping drive up the multiple side of things as part of the enterprise value calculation. But, maybe for our listeners, Eric and Dustin, what's kind of the biggest role a investment bank can play when it comes to the financial side of the equation?
Yeah, I would say the first kind of role we play is reforecasting historical financials. So as we touched on, typically there is no, there's not substantial adjusted EBITDA for a lot of, privately held businesses. So it's going in and making those adjustments, to EBITDA. The way we think about these adjustments as sell-side advisors, we have to kind of put our buyer hat on and say, what are adjustments that we think private equity firms and strategic buyers will agree with? We can't just add back items without support or without a good, strong rationale. So it's going in and really, building kind of defensible add backs, and then looking at projections as well. So working with our clients, really understanding some of the growth drivers of their business. Are there potentially new locations that haven't fully ramped up if it's an outpatient business? Are there new contracts that were in place if it's a contract therapy company or a hospital-based business that aren't fully reflected into the financial statement? So it's really working with them to put together projections for their business as well to really show the private equity firm and the strategic buyer what the growth profile of the business looks like.
Yes, and to those adjustments, I think one important thing is compensation. As Eric hinted on, it's really making sure these are market compensation. Often something that's presented to us is, let's add back, 95% of my salary, or something that is well below market because the physician or owner wants to receive a multiple on that and the better taxes. We can't necessarily do that because you have to think, what if that individual retires and how we're going to replace them? And if we're something well below market rate, that's just not a item that can happen and occur in the future for the company to operate there. So when we look at all these adjustments, we have to think, well, what if the company was, operating similar to, the scrutiny of a publicly traded company, or just more roles on it? And that's where we look at those adjustments to make sure that they will hit in the future.
Yeah, I think both those points are great. And, within the lower middle market, which is where we play, there's a lot of work that typically needs to be done by an investment bank or a third-party advisor in order to capture all of the appropriate add backs and also make defensible assumptions around the projection side of things. I think one tool that we often use and we see other advisors use as well is looking at also a revenue recognition type analysis to make sure that the financials we present in a memorandum to potential buyers match up with the statistics of the business that are underlying as well. So Dustin, going back to an earlier point of yours, we often see physician practices financials to be a bit different than other healthcare service companies like pharmacies or home health companies, et cetera, because a large portion of the revenue drivers of the business are also shareholders themselves. Dustin, if you wouldn't mind, I think it would be great for our listeners to hear about how you've approached compensation normalization and add backs related to large physician groups and shareholder groups.
Thanks, AJ. I think for compensation, it's important to realize there's no set standard or one way it has to be done. This is definitely something we like to work with, the CFO or controller of the company, as well as the owners, to see how compensation is currently being done and figure out a way that interests both the buyer as well as the seller on this matter so that all parties are happy. Typically, the two most common ways that we see compensation done are either on a percent of collections. So if an individual is, bringing in $1 million of revenue in a year and we assign a 30% target to it, they're going to make a $300,000 compensation. Whatever we back into on this model has to be something that's in market so that future physicians can be hired at this rate, because it is important to make sure that, for company morale, everybody's at a similar rate within that. The other would be a reduction model. So all physician practices, or not all, but a lot of physician practices have detailed compensation, whether somebody's reimbursed at a higher percentage for a more detailed procedure, as well as a lower percentage for maybe just a referral or something that the nurse practitioner may be doing. So what we'll do is take into that current compensation model the physicians are paid on, and we'll look at a reduction, whether it be 20% or 50% to that. Again, it has to keep them in market range, but there's not a set way we would go about this, AJ, and we want to make sure that our client is willing to work at this compensation model we set forth. And that's why it's important to make sure it's approved by them.
Yeah, and I would even add that specialty to specialty, the normalization exercise can vary significantly. So, a percentage of collections might be utilized for an ophthalmology practice, but when you look at other areas such as gastroenterology, where there are a number of different kind of revenue streams and ancillary services involved, typically there's going to have to be more creativity that goes into that compensation normalization exercise. And just kind of stepping back to the rationale behind this, if a shareholder is giving up some compensation, what's the benefit to them? Well, I think fundamentally when you look at a deal and you're getting a multiple on that, you're really converting that income that you would be getting, and paying ordinary income taxes on, you're converting that into capital gains proceeds out of a deal. So there's a tax benefit, and the fact that you're getting a multiple on that as well is really the reason why the economics of this makes sense.
Yeah, those are both great points. And from personal experience, it's kind of a push-pull exercise. The more dollars you give up on your salary as a shareholder in a physician group, it's typically more proceeds to you at close, given the multiple side of things, as well as that tax-affected difference between capital gains and ordinary income. But that being said, to Dustin's point, it has to be at a market rate that's not only feasible for the shareholders to work at post-transaction, but also a reasonable replacement cost to the extent that any of the physicians that are getting proceeds out of a deal wish to step away post-transaction. There's enough expense burden within the business to hire someone at a similar rate moving forward. I think lastly, on the topic of the role of an investment bank, since again a lot of our clients and a lot of groups within healthcare services fall in that bucket of lower middle market businesses, it's important to make sure that the financials that are prepared for due diligence purposes also align closely with the statistics that are underlying the business at the same time. Eric, would you mind providing some context to the readers on how we typically go about a revenue recognition exercise to help bridge the gap between the statistics and the financials?
Yeah, I would say for businesses that are billing Medicare and other third-party payers, we'll typically look at their billing system and get what we call kind of a data dump. So really all of the information that's within their billing system over the last couple years. And by running reports from that billing system data, we can look at what the revenue is in their billing system and try to reconcile that to the financial statements. If there is a gap in those financials, then we'd have to really understand from the client what other collections are coming in or what other revenues coming in outside of the billing system that could potentially reconcile to the financial statement. So it's really just preparing for any potential red flags that might come up later on in due diligence when the buyer or private equity firm does their third-party quality of earnings analysis, which we'll touch on later in this podcast, and making sure that our clients are prepared prior to going out to market.
Yeah, and I think that's a good segue to a key part of any transaction, which is the financial due diligence side of things. Dustin, what are kind of the key attributes of a financial due diligence process?
Yep, I'd say from a financial diligence process, the biggest task is getting a quality of earnings. So what a quality of earnings is a buyer hires a third-party firm, which essentially is independent. Sometimes we're often asked, are they really independent because they are hired by the buyer? But just like any accounting firm or other firm that is putting a report together, they have to be independent in the sense this is how their revenue is produced. And if they start publishing biased reports, they're not going to survive long. Within that QOV, the biggest thing is converting our financials often from cash to accrual. So being that we work and are discussing with physician practices, you often keep your financials on a cash basis because ultimately you care about what the cash coming in the door is. And that's how you pay the employees and you buy supplies and keep the doors open with that cash coming in. But sometimes that cash doesn't reflect the true operations of the business because you might be pushing out supplies so you're not paying them. You might be collecting a lot of money, some months and not collecting other months just based on how trends are working. So what we're going to do with that data dump is essentially, look at our date of service rather than the date of collections and build our revenue on an accrual basis. We then start to go through, the expenses, looking at, payroll. Some months might have 3 payrolls in a month and others 2. So it's more smoothing out, and same with expenses. Oftentimes, towards the end of a calendar year, we're going to see expenses increase because of supplies or bonuses paid to employees. So we have to recognize those over a fair period that they're earned to really give a fair representation of the financials and not show financials that have net income of $1 million in one given month and then negative $1 million in another month just because the expenses aren't smoothed out.
I think this next question ties into, Dustin, what you just mentioned in terms of capturing some of the future earnings of the business that are really performed at the date of service. A common question we get from physician groups in particular is what happens to their accounts receivable as part of a transaction. Dustin, what do you often tell groups that are asking similar questions to that?
Yep, I think it's important to mention, when we're doing that cash to accrual conversion, that accounts receivable is being recognized within the accrual conversion. So if we have, $1 million in our accounts receivable, we're recognizing that as revenue, and ultimately the deal is valued off that. So our client is seeing value for that accounts receivable. When looking at accounts receivable, it's built into a working capital target. So all deals include a working capital target, and what working capital is there to help the company operate at day one once it's a new company. So essentially the accounts receivable is going to come into the new company to help pay payroll and supplies of the new company. So you're not having to take a line of credit or other debt on within the company, and the company can sustain and operate as its own independent source. So I typically like to say, all accounts receivable is going to roll forward with the new company. That's not always true, because when we create this working capital target, we're basing it off a historical trending, whether it be 3, 6, or 9 months of what working capital has been. So if your accounts receivable is low for whatever reason, you might have to pay an additional money into it. And typically what we would see accounts receivable being low is, maybe you hired some extra billers because you thought you were essentially going to try to game the system right before closing and draw out all the accounts receivable. With that same fact, you could have had some billers quit or even been delayed on payments from an insurance company. So if you did have a delay in payments and your accounts receivable balance is built up, then you will see some benefits for that. There's other items taken into working capital, so we're not strictly going to be focused on our AR, but typically I like to think that as the company continues to operate, and assuming there was no unusual circumstances, that the accounts receivable is just going to roll forward with the new company, but you are receiving benefits on it because it's built into your accrual financials.
I think another common question we get is what happens to cash that's on the balance sheet and debt that's on the balance sheet at the time of close. Eric, in your experience, how's that typically handled as part of a deal?
Yeah, more often than not, the deals are cash-free, debt-free, meaning any cash on the balance sheet from our clients stays with them at closing, and they'll have to pay off any debt in the balance sheet as well.
I'd say a common theme that happens in many transactions is the company is growing. There's a lot of blue sky ahead, but it makes sense from a strategy standpoint to undergo a transaction process today. Eric, what are some of the ways that we've been able to kind of reconcile that in terms of having a growing business, but still wanting to do a transaction for strategy or liquidity purposes?
Yeah, I would say beyond really building out detailed projections with really good assumptions, I think you could also look at really pro forma adjustments. So an example of that could be, if it's an outpatient business, maybe there are 2 new clinics that opened in the last 4 months, and neither of which have really brought any earnings to the overall business, but they do have a lot of growth potential because it might take 5-6 months to really ramp up those locations. So one of the things we could look at is showing a potential investor or strategic buyer what those locations are going to deliver on a yearly basis in terms of profitability, and make a pro forma adjustment to the financials so that our clients don't feel like they're doing a transaction and essentially gifting away 2 new facilities that they may have just invested into. So that could be one example of a pro forma adjustment. If it's a provider-based business, perhaps there were 2 or 3 new physicians or providers that started within the last 2 to 3 months. Typically, what we see with providers, it could take them up to a year or 2 years to really ramp up to the full productivity of a typical employed physician. or provider. So we could look at making an adjustment to show what their 12 months worth of profitability that they'll be able to bring to the company. And the expectation is the buyer will give them credit for these new providers because it's something that they had spent the time to recruit. And obviously the upside of those new providers could be fairly substantial for the business.
And I think it's important to mention, as Eric was talking about, pro forma and then debt beforehand. So if they're opening up a new office and, you had to take on debt to build out the infrastructure of it and it's still ramping up, we can work there and make sure, either purchase price is increased or that debt is not included with the payoffs. Because if an office just opened, a month or two before a transaction, it doesn't necessarily make sense for the buyer to receive the full benefit of it, that where you haven't brought in significant revenue, if any, from the office as it's still building up. So there are definitely one-off scenarios where either not all debt's paid off or it's paid off, but essentially purchase price is increased to represent just that debt.
Yeah, and I think overall the messaging that in our experience says that if groups are growing, then the valuation multiple that they're able to achieve and just the enterprise value in general is going to be substantially higher than a business that's flat or potentially down because of lost production or potentially unprofitable locations that haven't ramped up even after 1 to 2 years. So our advice to clients is timing is really dictated by the owners of the business, but in terms of capturing that growth between the valuation multiple, reforecasting the financials, looking at pro forma adjustments, building out projections that a buyer will try to poke holes in, but we can make sure we support with data. I think with those 4 different kind of mechanisms, we've had a lot of success capturing and making sure our clients get credit for their growth.
I think those are both great points. Ultimately, in our experience, growth shouldn't be a penalty for our clients. And in the eyes of potential buyers, there is greater opportunity in growing businesses rather than flat businesses or declining businesses. So I think ultimately there's ways to structure around that growth, and where a lot of the interest lies from the investor and consolidator community is in those businesses, which kind of helps our cause in helping organizations that are going through growth while still considering a transaction at the same time. I guess lastly, in both of your opinions, what are some of the key things that a business owner or management team can do in order to prepare for a transaction from a financial perspective?
Yeah, I'll take this first, Eric. So I think the important thing is really having some back office operations. Having control of your financials is important, and being able to, assist with the cash to accrual conversion and being able to pull applicable invoices is really the important and where we start off. The data dump is the key. Sometimes when they're booking revenue, you're simply booking off, just looking off the bank statements and don't even take into consideration, how many patients we're seeing or what revenue is being brought in. So it's really working with that back system to figure out those. A question that's often asked of us, should we have a QOV before we go out to market or even a review or audit? And that's not necessary by any means. The only important thing that can assist us with is it really shows, okay, they made it through an audit, so they're able to pull the applicable information and really get us what we'll need at a later stage. And it gives us confidence that they have these items and we're not going to spend hours trying to figure out how to run reports. But often now, we spend more and more time trying to do these items beforehand, even before we go market, because we know then any issues we might have and how we're going to circumvent those issues and really figure them out along the way.
Yeah, and one thing I would say that in terms of maybe third-party work that could help before going to market beyond a quality of earnings could be looking at a cash to accrual conversion prior to going to market. And, in some cases that could make sense if it's a group that's growing very, very substantially. In our experience, more often than not, their accrual revenue is going to be higher than their cash revenue if they're on a very steep growth trajectory. So there are some instances where we would advise our clients to look at bringing in a third-party CPA firm to help do a full cash accrual conversion of all historical financial statements. And the benefit to the seller in that instance is while there is an upfront cost to that, they would be able to get full credit for their accrual revenue and accrual growth in a transaction scenario versus waiting for due diligence in the third party for the the private equity firm or buyer to put together their cash accrual analysis.
I think the other important thing is when we were discussing, a CFO or a controller in place, is the bottom line is quality of earnings, and all of due diligence can be a strenuous process. So having somebody there to assist is important because the physicians are the owners, and we really want them out practicing and growing their current business, or at least maintaining it, and don't want to distract them from their day-to-day operations by having to assist us with a large amount of financial requests.
Yeah, Dustin and Eric, I think both your points are very helpful, I think, to our listeners. And ultimately, each company is different, and each company has different levels of financial sophistication. But like Dustin mentioned, having a third-party advisor go through things with the management team, with the shareholders, and assess the right plan to prepare for a transaction process is really crucial. Certain companies are ready to go from a financial perspective immediately to embark upon a transaction, and there's others that require some upfront preparation and additional work before embarking upon a process, just to make sure that the full value is achieved that's inherent within the business, and also to make the transaction process go smoothly from start to finish. So that's kind of it for our podcast here today. We'd welcome your reviews and comments and suggestions either on our iTunes page, or feel free to email us at podcast@providenthp.com, and appreciate everyone taking the time to listen, and look forward to a future podcast.